Traders, in this video, I want to talk to you about a topic that I get asked a lot about. And that is, Darren, what is an acceptable win rate? Now, when it comes to trading, naturally, everybody wants a high win rate. Just have a look at the developers of trading robots advertise ridiculously high win rates to sell their product. They know that there's a burning desire amongst traders to achieve a high winning percentage, and they exploit it. But is that desire well-founded, or is it misplaced? In this video, guys, I'm going to discuss what I think the kind of win rate you need to become a consistently profitable trader. We'll also dig into some key factors that play a role in developing a trading edge. So what is a profitable win rate? Again, I get asked this quite often. It seems many traders want to know the win rate required to achieve consistent profits. But here's the thing. The question itself really has no legitimate answer. Sure, I can make something up and tell you that you need a win rate over 50% to be profitable, but that simply is not the case. It's simply not true. In fact, it is dead wrong. In the world of trading, win rates generally go hand in hand with a trading edge, a well-defined, well-formed trading edge. Most traders believe that if you lose more times than you win, then you have no edge as a trader. Well, that's wrong too. That is incorrect. You see, a trading edge is much more than your ability to win. It includes everything from discipline to the time frames that you trade on, your risk to reward ratio. It even involves the pairs that you trade and how you allocate your capital on each position that you take. If you do that right, all of these things come together to form a trading edge that puts the odds in your favor. As you're about to see though, putting the odds in your favor does not necessarily mean winning more times than you lose. It means having the ability to make more money than you lose over a series of trades. They are two very different things. So again, back to the question, what is a profitable win rate? Well, guys, there isn't one. A better question is, what other factors do you bring to the table that stack the odds in your favor? Do you use a favorable risk to reward ratio? Again, what time frames do you utilize? You adding to your profitable positions, which you should be doing. The answers to these questions play a critical role and come together to form the foundation of your trading edge. Let's talk about the myth of the high win rate. Everybody wants to win, whether you're trading or playing a sport, doesn't really matter. Winning is the goal. Unfortunately, too many traders, in my view, get caught up in this idea of a high win rate. To be honest, it's not just sort of controversial, it's nearly always a complete waste of your time. You see, you can lose more times than you win and still have an effective trading edge. Note that I said more times, not more money. A trading edge is a way for you to achieve a percentage above 50%. It's more than just that. In fact, if you only measured on whether you have a trading edge against your win rate, you're missing the big picture. I've had many months where I lose more times than I win, but in those months where I use techniques such as favorable risk to reward ratios and pyramiding into my positions, I still came out ahead. Let's take a moment to discuss both of these strategies now. First of all, a favorable risk to reward. Your risk to reward ratio can single-handedly save you from having a losing month. For instance, let's just say you took 10 trades last month. Out of those 10 trades, you lost money on 6 of them. So your win rate was just 40%. This is where most traders get it wrong. They look at the 40% and they say, you know what? I don't have a trading edge because my losing trades outweigh my winning ones. Wrong. Absolutely wrong. Your edge as a trader is a combination of factors. As I said, it is never about how many times you win or lose. That's an overly simplistic view, and in my opinion, it's also a misdirected one. Going back to our example for a moment, if you had lost on 6% of the trades over the course of that month, but employed a 2R minimum risk to reward ratio, you would have still come out ahead. Here's how that would look. We could make an argument that not every winner will achieve a desired 2R result, but you'll also have trades that exceed the 2R minimum. 2R being twice your allocated risk amount. No matter how you look at it, a favorable risk to reward ratio is a powerful addition to any trading edge, turning a 2R profit into a 4R profit without risk. Pyramiding is a simple technique that accounts for the majority of profits, my profits, in a given month. Just like having a favorable risk to reward ratio, if you aren't pyramiding into your positions or adding to your positions, you're missing out big time. I'm not going to go into a ton of detail about how you go about that. However, the idea is to strategically add to a position as it moves in your favor. The key word there is strategically. You don't want to blindly add to a profitable position whenever the urge strikes you. Instead, you wait for the close above or below, for example, a key level before considering whether to add to a position. Pyramiding alone can turn, again, what would have been a 2R profit into a 4R profit trade or more. It's that powerful. At the end of the day, a true trading edge in the Forex markets means putting the odds in your favor. Those odds are not about winning more times than you lose, traders. They are about making more money when you win than you lose when you lose over a series of trades. And there are many ways to accomplish that outside of a high win rate. A trading edge is a combination of factors, and your win rate, whatever that might be, is just one of many. So there you have it, guys. You don't need to win 90% of the time to come out ahead. You don't even need to win more than 50% of the time to make consistent profits. Again, your trading edge is far more than that. In fact, your win-loss ratio is just one piece of the puzzle. Other things, as I mentioned before, like how often do you trade, the time frames you trade on, your risk to reward ratio that you can logically get out of the market. You employ all these factors that determine your level of profitability. Many traders get caught up in the idea that consistent profits are synonymous with consistent winning. Now, perhaps it's an ego thing, or maybe it's something less obvious. Then again, our industry is made up of 90% of men, so maybe ego may be a good guess in my view. Either way, guys, you don't have to win all the time, or even the majority of the time, in order to achieve consistent profits. And that's the name of the game, a smooth growing equity curve. That's what the trading robot salesman would have you believe. But don't fall for it, guys. I want to finish with this. George Soros famously said, "It's not whether you are right or wrong that's important. It's how much money you make when you're right and how much money you lose when you lose." In other words, things like your risk to reward ratio, and again, pyramiding into your profitable positions are also cornerstones of an effective trading edge. So guys, thank you for watching this video. I'm glad you've taken the time. Talk soon. Bye for now.